Good morning. It's Monday, the 8th of December, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. The take. IndiGo is no Infosys. We're currently witnessing an extraordinary and intense blame game and buck passing exercise, the likes of which one does not recall seeing in Indian business, at least for a while. Let's back up a little. IndiGo, an airline that needs no introduction at the moment, was founded in 2005 by two friends, Rahul, Bhatia and Rakesh Gangwal, who had near equal stakes of about 38 and 37% each. Bhatia had already built a successful travel and logistics business in India. Gangwal was CEO of US Airways, which later merged to become American Airlines. He was an accomplished aviation industry professional and an early riser amongst Indian origin CEOs in the United States. The first move from IndiGo was when it shocked the industry with its first aircraft order in June 2005 at the Paris Air Show for about 100 Airbus A320-200. The airline started operations in July 2006. The travel and trade industry was convinced Bhatia was one of those, or rather another one of those flamboyant wannabe aviation entrepreneurs whose dreams would eventually meet the same fate of as many others in the three-decade history of Indian private aviation. Except that he and Gangwal were not fly-by-night operators people thought they were. IndiGo emerged as a young, cool-looking and sounding airline and grew rapidly. In 2015, it went public, and its stock price has generally done better than most global aviation stocks, leave alone Indian, and aviation stocks, as you know, tend to languish at best. But by 2019, the Bhatia-Gangwal friendship had soured. A battle that must have raged within the boardrooms and corner offices for a while exploded in the open. Gangwal went public with his grievances, and in a complaint to the Securities and Exchange Board of India, or SEBI, he alleged that Bhatia was running the airline like a personal fiefdom. He accused him of several violations of SEBI norms and said he was running IndiGo like a pan ki dukaan, or a pan shop, adding he had lost confidence in the current composition of the board and its ability to discharge its fiduciary duties, as most of them were Bhatia appointees. Amongst other charges, Gangwal said Bhatia entered into related party transactions with firms privately owned by him. Now, Bhatia's response was that Gangwal's complaints were an attempt to dilute the founder's rights and control, which were agreed upon. He added that all related party transactions were transparent and legally approved. Now, in any corporate battle, there are two sides. Of the two, Bhatia's side has been more careful with its responses, seemingly not addressing the substance of some of the charges, like the one about running the airline like a fiefdom, but no doubt it's a subjective charge. Fiefdom or not, Gangwal decided to exit the company and worked out a gradual exit where he started paring down his stake. A Mint report said that through 15 transactions starting in September 22, he sold about 32.5% and earned about 45,146 crore rupees. Now to the present. The fiasco of the last few days needs no further elaboration except to highlight that the company clearly took a decision to not abide by the new flight duty time limitations on pilots that kicked in on the 1st of November 2025, for which there was enough time. The airline was effectively attempting to service an expanded winter schedule with the same number of pilots who would fly fewer hours than before. No maneuvering on an Excel sheet would have saved the airline at this point. Excel Sheet Airline is, by the way, what several of IndiGo's own pilots call their employer a barb that also acknowledges the ruthless precision with which the airline has been run. Now, the Director General of Civil Aviation, DGCA, has sent notices to its CEO and operations head, both of whom are foreigners, demanding answers. Nowhere is there any mention of founder and majority owner Rahul Bhatia, who's not made any public statement, at least that I have seen. The media coverage appears to target the Civil Aviation Ministry specifically, almost like it's not part of a larger government, and of course the airline. Bhatia is conspicuous by his silence and absence. Let's take another step back. Anyone who knows and studies Indian family-owned or promoter-run businesses knows that key decisions are largely taken by the owner, if not endorsed by them. It seems almost impossible that IndiGo was taking liberties with upcoming regulations without the owner knowing about it. And thus, or either way, Bhatia must be held accountable first, everyone else later. The board is accountable too, but they are perhaps last in the pecking order and not the first, as some are making it out to be. It is an open secret that most Indian boardrooms are fiefdoms of different shapes. As long as the owners and or managers deliver returns, shareholders are happy, and IndiGo has delivered until now. There are some well-performing companies where the accountability ends up with the acting or operating CEO, like many listed multinationals and some Indian companies. Infosys is an example of a company whose founders set up and ran the company in rotation, as it were, till they all retired. Even when disagreements surfaced, like over the choice of a professional CEO, when the founder stepped aside, the allegations were more about style and not respecting Infosys values. There was no doubt that the board was in complete control of the CEO and the company, which continues till today, and there are many other examples, mostly in the technology services space. Now, IndiGo is no Infosys. It is an owner-controlled, if not managed company. It is not at all evident that the owner has stepped back from the company. So, while the IndiGo brand has suffered incalculable damage, it can recover from its mistakes and the beating it has taken. The stock market clearly trusts it too, going by analysts' bullish comments on its long-term prospects, which means the markets also believe, even if partly so, that there is Bhatia's iron hand guiding the company. Gangwal may have accused Bhatia of running IndiGo like a pan ki dukan. The airline has to demonstrate now it is not one. And that brings us to the top stories of the day. The stock markets recover on a rate cut. Why the market's divergence is growing wider. India will slow down on coal power plants, the India Energy Week segment. What the latest rate cut means for the economy. And will a Netflix acquisition of Warner sail through, streaming now?
This is a Core Report with Govindraj Ethiraj.
A rate cut jump. The markets cheered an interest rate hike, which was mostly expected, at least on the Core Report on Friday. Interest rates are now quite low by any standards, as we will find out shortly. What that means for the rest of the economy is not fully clear, as transmission does take time and sometimes retail borrowers barely feel the change. On Friday, the Sensex and Nifty rose after the Reserve Bank of India slashed the repo rate by 25 basis points to 5.25% and maintained its neutral stance and revised its inflation forecast for the current year to 2% from 2.6% earlier and raised growth projections from 6.8 to 7.3%. So with all of this, the Sensex closed at 85,702. That's up 447 points, while the Nifty 50 was up 152 points to 26,186. In the broader markets, the Nifty mid-cap was up 0.49 and the Nifty small-cap dropped 0.5. Now, a little alert worth paying attention to in the context of how narrow the recent gains in the market are. So the BSE small-cap index has hit an over 6-month low, falling 1% in Friday's intraday trade, despite the benchmark indices rising, as we just discussed. The index last touched its 52-week high in December last year and has corrected 12% since, according to a report in Business Standard. Meanwhile, in the calendar year, that's 2025, the BSE Small Cap Index has underperformed the market by falling 8% as against 9%. That is the rally in the Sensex and a 0.3% decline in the BSE Mid Cap Index. So now you know, or you can see, how the benchmarks are doing versus the others, and many people or retail investors would have exposure in the mid and small caps. And before we continue, join us for the third edition of our partners Algorand India Summit on December 6th and 7th, 2025 at ITC Gardenia Hotel, Bangalore. Registration link in the show notes, and let's get back to the show. The rupee strategy. The rupee is on a weak footing versus the dollar. Whether it will remain so is an economic and perhaps even philosophical question. Should the Reserve Bank keep selling dollars to lift the rupee, or let it float a little, as it has evidently done in the last few weeks? Because a depreciating rupee is the best available buffer, as we've just discussed, against the tariff shock that Indian exporters are facing, and particularly to the United States. Now, the Reserve Bank will tolerate a weaker rupee as the country's external sector confronts multiple headwinds, including a wider trade gap and stalling of dollar inflows, according to Reuters, which is reporting basis conversations with people in the central bank. Now, the Reserve Bank of India, which supported the rupee through aggressive interventions via dollar sales until last month, has now allowed the rupee to fall about 1.3% in the last 7 trading sessions to a record low of 90 rupees 42 paise. The rupee is also down about 5.5% this year and is Asia's worst performing currency. The sources also told Reuters that by signaling tolerance for a weaker rupee, the central bank is indicating it will intervene mostly to curb sharp volatility or on any signs of a speculative build-up, but not defend any specific level on the rupee. Now, this is obviously something that's also, in a way, unstated government policy, given the fact that the country's chief economic advisor on Wednesday said he was not getting sleepless nights over the rupee's fall. And if there was a time to depreciate for the rupee, that is, this was it. To come back to the sources at the central bank, according to them, it doesn't make sense to spend reserves when fundamentally everything is against the currency. And they also said that as and when fundamentals and real dollar demand dictates, the central bank does let the rupee move more than it normally would. And of course, there is the fear that speculators who are already believed to be flexing their muscles will move in more actively. At that point, the central bank could step in and stamp out those as needed, according to those sources who spoke to Reuters. And finally, on Thursday, the rupee did end above the 90 per dollar level after hitting a record low as dollar sales from multiple foreign banks, likely on account of inflows, helped the currency snap a 6-session losing streak. The rupee fell to 90 rupees 42 paise early in the session before reversing course to close at 89 rupees 97 paise, according to Reuters. Coal capacity. And here's our India Energy Week segment. Oil prices were up about 1% to a 2-week high on Friday, again on increasing expectation that the US Federal Reserve will cut interest rates, which could obviously boost economic growth and energy demand. And then, of course, there was the issue of geopolitical uncertainty that could limit supplies from Russia and Venezuela. Brent was about $63.75, just under $64 a barrel. Elsewhere, India does not have any immediate plans to add coal power generation capacity beyond 2035, according to a power ministry official who spoke to Reuters. The power secretary of the government of India told Reuters that India wants to secure its energy requirements, as on 2035 we want to have a coal capacity of 307 gigawatts. India was looking at increasing coal capacity by about 46% from the current 210 gigawatts, while doubling non-fossil fuel capacity of 500 gigawatts by 2030. The power secretary said the coal power plans are in line with the country's energy requirements, and India is facing grid challenges because of integration of surplus clean energy into the grid and has curbed power output for many months this year. The power secretary said India could take a call on adding more coal capacity after taking 3 years to understand how power demand is growing and, more importantly, the speed of integration of clean energy. And this segment was supported by India Energy Week 2026, to be held from January 27th to January 30th, 2026 in Goa. You can register for the same using the link in the show notes. Interest rate impact. The Reserve Bank of India cut interest rates last Friday, a move that was expected by some but not all economists and Mint Street watchers. Ratings agency Crisil was amongst the few who called an interest rate cut, and it acknowledged the Reserve Bank's move to announce open market purchases of government securities and a USD INR buy-sell swap to improve domestic liquidity amidst volatility in the markets. Crisil's view is that between lower than expected inflation and higher than expected growth, the Monetary Policy Committee of the Reserve Bank of India focused on the former, which is lower than expected inflation. So, the Reserve Bank has revised its inflation outlook downwards, giving it space to cut policy rates. It also expects GDP to moderate in the second half, some signs of which are already visible in recent high-frequency indicators, according to Crisil. It also says it expects rate cuts to play out in the coming year, as the monetary policy typically operates with a lag. Now, headwinds to growth are likely to continue from high US tariffs and moderation in government capital expenditure. I reached out to DK Joshi, chief economist of Crisil, and I began by asking him what he had taken away from the policy.
Well, I think my simple argument was that the inflation is now below the lower limit. There is some reason rationale for giving 2 to 6%. I think if it is up more than 6%, there's need to be worried. If there is less than 2%, there's also, I think, some concern that arises, because that means lower nominal GDP growth. So not that RBI is targeting nominal GDP growth. The point I'm trying to make is that the inflation was much below what the central bank targets. And in the coming quarter also, inflation is likely to be lower. So there was ample reason to utilize this opportunity. Growth came in very strong. A part of the reason was the base effect. Part of the reason was also the deflator, which was very low because of both WPI and CPI being low. In the second half of the year, we were expecting a slowdown to 6.1%. So that our forecast is 7% for the year. So, and RBI also is predicting a slowdown, but not that much. And all the risks that are coming from the global economy are very much there. There's very little risk to inflation right now, because there is excess capacity globally. That means goods inflation would be broadly under control. China is also exporting its deflation. So I think on the inflation front, there is not much risk, except maybe food. Food is very volatile. And core inflation is also low. It is not showing any indication of excess demand pressure on the inflation, because excluding gold, core inflation is only 2.6%. I think there was ample reason to believe that there could be a rate cut, though I would call it a close call because growth was also strong. So I think that's why we were expecting the rates to be sliced by another 25 basis point because of the opportunity and also to take care of risks ahead. So it's like an insurance cut right now.
Two questions. So one is the repo rate is 5.25, the standing deposit facility rate is 5. And what does this mean to borrowers in terms of what the transmission could be, retail or institutional, and what could really change in the hands or in the books of borrowers?
Well, I think the cost of borrowing will set. I think the objective of rate cut is to transmit it to the lending rates. And I do believe that over a period of time, I think gradually the rate cuts from RBI will get transmitted. And don't forget that along with that, the central bank has also announced liquidity infusion, OMOs, etc. So all those things are also going to enable transmission. So there will be lower borrowing cost for a number of borrowers. I think that's how I view it. And it may not happen instantly, but it will happen over a course of next couple of months. And I'm not expecting any rate increase in the next year also. So I think there'll be ample time for it to transmit. So it's a growth supportive move, I mean, broadly, via lower borrowing costs for majority of borrowers. And typically, I think the rate sensitive sectors do get some support from this. It could be auto loans, it could be housing loans.
Right. How are you seeing the current interest rates in India in the context of historical interest rates? I mean, how long or how often have we been at these levels? And secondly, how do these compare to international rates right now?
Well, I think I would say that this 5.25 would be roughly the average of last 10 years. So it's around average. I mean, we've seen a repo rate even below these levels, but that only happens when you have too much risk to growth. And that's not the case right now. Now, globally, I think many central banks did cut rates. I think much before they started cutting, even before we did. But the scope for rate cuts is now reducing because there is the outflow of capital in general, and there is the currencies have recently been under pressure in Asia and also some of the emerging markets. So every country has its own space for a rate cut. And US interest rates, I think we believe that there's a rate cut coming from the Fed in the month of December. And I think this will be followed by some more rate cuts going ahead. So the interest differential between India and US is not going to be bothersome, so to say.
Right. Things have not been very strong on the external front, notably the rupee, which has been depreciating. Now, the Reserve Bank, of course, seems to be now clearly saying that they will not really interfere with its direction. My larger question is, does this, which is the interest rate cut that we've seen, have any impact, or how does it connect with what's happening on the currency front? And also, if you could talk about these open market purchases.
Yeah, I think rate cut is not very good for currency, in very simply put. The point is that currency behavior is not a function of rates alone. I mean, it's a function of many other things. I mean, the uncertainty that is prevailing. We've seen capital outflow continue for several months now. And it's good fortune that we have very low current account deficit. So you are not too much dependent on the mercy of foreigners to finance your current account deficit. And at the same time, there is also forex reserves to cushion the currency against extreme volatility. Even in the past, I think we have seen that when the rupee comes under too much pressure, I think the central bank lets it depreciate. Global financial crisis. Right now, it's not a crisis situation, but point I'm trying to make is that you cannot swim too much against the tide. I mean, you can only suppress extreme volatility. So I see the current moves in that context. And rupee has been under pressure because I think India is facing the highest, almost the highest level of tariff that any other country is facing. Probably Brazil has the similar rates. Obviously, there is a huge amount of uncertainty in general, and the capital is anyway moving towards US. I think US is heavy on investments right now. So I think all these things put pressure on the emerging market currencies. And India has seen more pressure than others, despite its very resilient external accounts. I mean, its foreign borrowings are not that high for the government. And as I said, the current account deficit is also low. And as far as the open market operations are concerned, I think they infuse liquidity into the system. I think when the central bank intervenes in the forex market, it sucks the liquidity out. And to compensate for that, I think you need to pump liquidity into the system. And central bank has been maintaining liquidity at a given level, which is called the ample level, but it comes under pressure from time to time. And the open market operations will also help, I think, soothe the bond yields for the government bonds.
Right. We're coming to the end of the year. What else, or rather, what are you looking out for now in terms of data points as we go into end December or January, which will give, let's say, further insights into what is happening in the economy?
I think first thing from an external point, I'm looking at whether when does the trade deal conclude, because that will reduce a lot of uncertainty that is currently prevailing. Otherwise, I think the environment will remain pretty volatile. On the domestic front, I think even the central bank did mention that the growth is extremely strong, but they also mentioned that there are some hint of weakness. Particularly, I think the industrial production data was not that strong. Right now, I think the stimulus from the GST, I think that is continuing because the goods prices are low, inflation is low. That's going to support consumption. Now, there is one welcome change which is visible, that the private corporate investment is beginning to show some signs of revival. Now, I think we've seen false starts in the past also, but I think that is something I would be monitoring very closely, because government's ability to push investments into infrastructure, which they have been doing at a faster pace post the pandemic, I think that now will have to normalize, which essentially means that the government capex will grow at the same rate as nominal GDP. In that situation, I think the private corporate sector has to take the baton from the government. And I think there is some indication of that. I think that is one variable which I would be very closely monitoring. The second is the industrial production data, which came in very weak, whether it is one-off or it is going to continue to remain that weak. So I think that is the second variable that we need to, because remember that the second quarter GDP growth was largely because of industrial production going up. And I think the deflator had a role to play there. So I think these are two things, I think, on the domestic side that I'll be watching. And I think obviously there is some sign of the revival in the urban segment, and where I think interest rates play a bigger role. So I think that is another data point that I would be watching. And one more data point, which is very important, because rural demand has been pretty strong. But right now we are seeing very low food inflation, and we are also seeing many crops selling below the minimum support price. And that's not really good for the farmers, I think, for their incomes, etc. So I think these are some of the things, 4-5 things that I would be focused on as we step into 2026.
Right. That's a very useful sum up. DK, thank you so much for joining me and sharing your views.
Thank you, Govind. It's always a pleasure.
Netflix Warner buy may face hurdles. The Netflix and Warner Brothers Discovery deal came together quickly, apparently, but its path to regulatory approval may not be as speedy, according to CNBC. Netflix took the media industry by shock on Friday when it announced its proposed $72 billion to acquire Warner Brothers film studio and streaming service HBO Max, and that combination would bring together two of the most popular streaming platforms. Netflix had about 300 million subscribers, that's global as of late 2024, and HBO Max had about 128 million as of 3 months ago. Netflix says 46% of mobile app monthly active users in global streaming are theirs, according to data from market intelligence firm Sensor Tower, quoted by CNBC. Combined with HBO Max, that share would rise to 56%. Now, the size of the deal apparently makes it ripe for scrutiny from both industry insiders and US lawmakers. CNBC said on Friday that the Trump administration is already viewing the merger with heavy skepticism. Senator Elizabeth Warren, a Democrat from Massachusetts, said that the deal looks like an anti-monopoly nightmare, and Netflix Warner Brothers would create one massive media giant with control of close to half the streaming market, threatening to force Americans into higher subscription prices and fewer choices over what and how they watch, while putting American workers at risk. The merger would obviously give Netflix control over the Warner Brothers film studio, which would obviously mean further consolidation in the cinema space, and raising concerns that the number or typical windowing of popular releases could shrink, according to CNBC. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.